We are back, ladies and gentlemen. Welcome to Kicking with the Rickens, Redefining Retirement. I'm your co-host, Doug Turnbull, here with Heidi Ricken-Provost and Gerry Ricken, the daughter-father tandem, here to help tackle tax diversification. We've already had 3 episodes, first defining what tax diversification is, then talking about traditional accounts, and then the Roth, the HSA, and the 529. Go back and listen to those on Apple and Spotify and YouTube and some other podcatchers. You can also click the podcast tab on rickenfinancial.com. And hey, while you're there, go ahead and schedule that appointment and get talking to Gerry and Heidi and dial them up to 314-442-6476. Heidi, Jer, how are we doing today?
We're doing fabulous. How you doing, Doug?
I'm doing great, thank you. I'm good.
You're looking good.
I appreciate that. I got the red on ahead of Valentine's Day here. That's when we're recording. Y'all are having tonight the Galentine's Day event, so you're all decked out too,
indeed.
Heidi. And
I'm not going to that.
You're not going.
Sorry, you're not invited because it's for ladies to celebrate ladies.
That's correct too. And then coming up at the end of March as well, you have your women's seminar.
Absolutely.
And that's going to be in the office, or is that out? That's
out at Trattoria Toscana, which is a local restaurant at Gravois and Lindbergh. So, we're excited to bring that to everyone. And one of the reasons why we can't really host much at the office in the next few months is because, spoiler alert,
we're out of space.
Yep. We're expanding and growing, and we need a little bit more space. So we're moving super far away. All the way down the hall and the stairs of the elevator to the first floor of our building.
Congratulations. That's a big deal.
Thanks.
And now you nailed picking out your colored shirt for today, but it was a little bit harder trying to figure out the complexion and paint for the studio. Did I understand that correctly?
That is correct. Gerry and I spent quite a bit of time this weekend looking at the thousands of different colors from Sherwin-Williams. And
those inch-by-inch paint splotches are a challenge.
We thought we nailed it. So we came down to 2 grays and 2 different purples.
Okay.
And then my husband had a great idea. He said, why don't we get a little bit of paint of both and just stick it on the walls down there? And I'm like, actually, that's not a bad idea, because we thought we nailed it with the color on our walls, and I've come to like it here. But when it went on the walls, we came in one day and we were like, oh my God, this is like green, gray. What is happening? So.
Oh, okay. Yeah, well, leave it to Steven, the engineer, to have it.
Oh, yeah.
To
absolutely.
Do the proper test. Now, true or false, guys, were you sampling thousands of paint samples just so you could get an extra whiff of the fumes? I just want to know. No, I'm just kidding. I'm just kidding.
Hey, we didn't even get the fumes because we were looking at the tiny little chips.
Oh, the chips. Okay. I thought maybe they were doing little splotches on the paper like they do in the store sometimes.
But they've gotten really ahead of the times. You can actually get like a little 8x8 peel and stick it on the walls to see if you like the paint color nowadays. But thanks to this guy above my shoulder, Grandpa Willie, I actually know how to paint. So we painted quite a few walls, the different colors, and I thought for sure I was going to choose the opposite of what we chose.
Wow.
It's amazing when it's up on the wall under the same lighting, lights make a huge difference wherever you go.
Oh, yeah. I have to say, it's not my wheelhouse, and that's precisely why you typically go to an expert for things that are not in your wheelhouse. And
that's why you come to us.
There it is.
Yeah, as painful as choosing paint was, I hope to not make taxes that painful for you. That's our goal. We like to have fun when we're talking tax.
I can just walk out. You've got this, okay? You got this, but that is true. People in a certain field, right, that look at it over and over and over again, that they could see a flaw in something a lot faster than someone who's coming in with their life savings for the first time in retirement. So I mentioned we've been through this battery of tax diversification. This is part of a longer series. We have about 10 different methods that we're covering here through these. So today, I'm just going to let you bring into it because it's something that I have not talked a lot about before, about net unrealized appreciation and capital gains.
Absolutely.
Yeah, we're gonna launch into capital gains first, and this is the first time we don't have an acronym when we say it, but we actually do, because there's long-term capital gains and short-term capital gains, and those are LTGC, and so there are. But we typically talk about those as themselves, long-term and short-term capital gains.
LTCG.
Oh my gosh, did I do a Philadelphia Mayor thing? Oh my gosh, I did the Philadelphia Mayor thing.
Hey, it's all good.
That's funny.
We're a little passionate about taxes, and when we start talking about it, sometimes we never know where to stop because we could talk about taxes all day long. And we're only going to really touch some basics here because we could talk about capital gains for, I don't know, hours. So let's get into some basics. In generalities, there are two forms of tax, basically. Ordinary income and capital gains rates. So there's two different tax rates when you're filling out your income tax return. Your ordinary income is going to be like your earned income, your dividends, interest, retirement accounts that are coming out, the amount of your Social Security that's taxed, all that stuff that's coming in and hitting your tax return, you're going to be taxed at ordinary income tax rates.
Right.
And those are the ones that people typically talk about, like, oh, I'm in the 20% tax bracket, I'm in the whatever. That's what they're typically talking about. And when you're a higher wage earner, your ordinary income tax rates continue to increase and you're paying more and more tax. So that's one basic, tax knowledge. And the other is
capital gains. And when we speak about capital gains, people really don't understand what the origin of that name was.
Yeah.
But it's a capital asset. When a capital asset is sold, that can be an investment, that can be a rental property, that can be a commercial property, that can be anything that is an asset. Basically it's a capital asset and it's sold. Then the government finally said, okay, these have been appreciated for years and years and years. Now you're going to sell them and you have the opportunity to pay the increase of that asset as a different tax rate than ordinary income taxes that Heidi was talking about. So when we talk about short-term and then there are short-term and long-term capital gains rates, short-term means you've held that asset less than a year. Long-term simply means you've held it longer than a year.
So when we're talking about tax diversification, we're really going to dive into long-term capital gains because they're more favorable tax-wise.
Okay.
And that's when, if you think about it, in your retirement, your long-term capital gains rates might be kicking in when you sell your home.
Oh, yes.
When, and you downsize or you right size or anything like that. When you sell your rental properties, when you sell the stock portfolio that you have put a bunch of money into for all these years, and now you start selling and living off of some stuff because you're in that decumulation phase of your life where you've already accumulated these assets, and now it's time to spend them, to decumulate them by living on them, by having fun with them, by doing all of your retirement goals with them. So when we talk long-term capital gains, why is that something that you should be utilizing in your tax diversification portfolio? Well, if you structure your tax return properly, you might not actually even have to pay tax on any of your gains. And if you do, chances are you're probably going to be spending less tax on your capital gains than you are your ordinary income tax rates because of the way that the capital gain law is written. So this is one of those other tax components that changes every single year, and you need to know what the limitations are and all of that. But for long-term capital gains right now, if you're single and your income's less than $47,025, if part of that is capital gains, you don't have to pay any tax on that capital gain.
Ah, okay.
So there's a way to make money without having to pay tax here.
Right.
Then we have a 15% tax rate on capital gains. So 15% would be the rate that you'd have to pay on that gain. If you make between $47,026 and $518,900. So there's a
We're talking
huge
about taxable income here.
Yes, taxable income. There's a huge band there, okay? So if you think about that, Doug, I don't know how familiar you are with the tax rates, but if your taxable income is over $500,000, your ordinary income tax rate is a hell of a lot bigger than 15%.
Sure.
So it's a way to be able to utilize different parts of the tax structure and, pay capital gains rates instead of ordinary income. But, we like to do it both ways. That was single. If you're married, that 0% for your capital gains is if you make $94,050 or less.
Okay.
And that, when you say make, that's taxable income.
Yes.
So that's household income, $94,000-ish or less. And then there's does the bigger window change for when you're married? Like, is the combined household income almost double too?
Yes. So the 15% will be your capital gains rate if you're between $94,051 and $583,750.
So it doesn't quite double like it does when you're single. It doesn't go from 500,000 to $1 million. It only adds 83
exactly.
on. Okay.
Yeah. And then, you would pay 20% on capital gains if you're over that, 518, 900 if you're single, and 583, 751 if you're married. So once again, this is a quagmire. It's the tax system. We like to make it as difficult as possible when we're the IRS, which, by the way, we are not. The IRS likes to make it as complicated as possible for all of us. If you need help deciphering this, you don't have to do it alone. Give us a buzz, 314-442-6476, because when you look at this, it's like, am I reading English, or what does this even mean for me? And, sometimes you don't know how to structure things, or the investment that you're in may not be providing you with the opportunity of capital gains rates, and you might have to be paying ordinary income on it. But with one simple change of your asset allocation or how it's traded, you might be able to take advantage of capital gains rates instead of ordinary income. But, capital gains rates only comes into effect with what we call a non-qualified account. So remember from our first episode on tax diversification, qualified accounts are those Roth, traditional, are retirement accounts. Their tax qualification status is for retirement.
The 401ks, the IRAs, the 457s, all those stuff.
Yes.
Right.
Capital gains would apply to our non-qualified accounts that you already paid the tax before you invested this money, but any of the gain that comes out of it or the income that comes off of it is going to be taxable to you. So that's what we're talking about here with capital gains.
And when we think about the gain, it is what you paid for it, which is the cost basis or tax basis, versus what you sold it for. It's the net between the two, and that's what you pay tax on.
I see. Okay, so if you hold it the whole time, so to speak, then it's not a problem. It's more when you sell it and it's gained value.
Yeah.
Correct.
Got it.
Exactly.
Okay.
And one of the reasons why this falls into tax diversification for your retirement as well is because if you have funds that are qualified, that are in that, traditional or Roth form, and you're living on your funds in retirement and spending them down, and you also have these non-qualified funds that qualify for capital gains rates that you don't necessarily need to touch because you can touch other forms of income, and you want to leave a legacy behind to the future, you can maximize these capital gains assets, your unrealized capital gains in them. And if you don't have to touch them, then in the future, when you pass away, your children will inherit these assets. Say it's your home, say it's your stock portfolio. Whatever the value is on the date of your passing becomes your kid's cost basis or your beneficiary's cost basis. And when they inherit those, if they sell it same day or before there's appreciation, they won't have to pay any taxation on this. So it's a way to keep more money in your family while you're alive and when you're gone. Because if you're leaving a legacy behind, you probably want to make sure that that legacy goes to your family and not to the IRS, because you worked really hard for that legacy to go as much as possible to your family and not to the IRS.
You name beneficiaries for a reason. We want the money to go to those beneficiaries that you name and not the federal government.
And so what do people need to know about these net unrealized appreciations? And I'm sure you've seen these up close and have some stories of that potentially being successful and how it interfaces with tax diversification.
Yeah, so we were just talking capital gains rates versus ordinary income. So what's a net unrealized appreciation and where may it fall, in your portfolio? Well, if you worked for a company and you put money into your traditional IRA fund over the course of the 401k at work and you held company stock in that retirement account, you might be eligible for net unrealized appreciation or an NUA. What's an NUA?
A lot of companies, large companies that are publicly held, allow that option to actually purchase company stock in your 401k, and they will match it with company stock. So they encourage employees to do so. And there is a tremendous opportunity if you know about it when you retire and take that money out. Every penny that comes out of, when you think about a 401k, every penny that comes out is subject to ordinary income tax, with one exception. That has to do with the company stock that you own in that account. And Heidi, how's that work?
Well, if you're still working and you change careers and you decide that you're going to move from 401k to IRA, don't do so without a conversation with us, please, if you hold company stock. Or when you're retiring and, you want more access to something else, or you want to take advantage of this net unrealized appreciation and move from 401k to IRA form, here's how it works. Like any other stock, we have a cost basis that's been taken into consideration your entire working years. So whatever you paid for that stock while in your IRA while you're working, in your 401k while you're working, your retirement plan while you're working, whatever you paid for that has been captured in the form of cost basis.
And by the way, that's the only thing in your 401k where cost basis matters.
Okay.
Yes. Because everything else, it doesn't matter what you gained. You have to pay ordinary income on every single penny coming out.
Sure.
So what you do is you take that company stock that's an IRA form right now, and you roll it into a individual stock account, and it becomes an individual stock portfolio of that company stock. So now, at any point in time, when you take money out of that account, you would only have to pay capital gains rates on any income that comes out of it, not ordinary income. But you do, in the process of doing this, have to pay ordinary income tax rates on the cost basis of that stock. It is so complicated to explain,
Yes.
especially as you're sitting here listening to us. You're like, I'm sorry, who's on first? What's on second? At the end of the day, we'd be happy to draw it out for you and see if it makes sense for you, because when we sit here and explain it, we're just going to talk in circles. But
Yesterday, we had the opportunity to meet with 2 different clients, 2 different meetings, where we talked about this because both of them had company stock in their 401ks. They had no idea that there was going to be a tax benefit to that. So we explained it. We go to our whiteboard, we draw it all out, we make sure that they understand it, and then we move forward.
yeah, absolutely. And, you know, the TLDR, as they say, the young kids say nowadays, the too long didn't read. Hey, if you have company stock in your retirement account, you might be able to save some money in the future. Just reach out. It's worth a complimentary conversation with us to see if it helps benefit you and your family for the future.
The only way it wouldn't benefit you is if tax rates completely change upside down.
Yep.
Yeah. So basically, there are buckets within your different retirement income buckets, and depending on where you put that money, they can actually have lower tax rates sometimes than you realize. So to help navigate people through all of that, because it is complicated here, I'm simple. All right, I would need some help. All right, and what do we do, guys?
You know, we try to keep things simple for everyone because that's how you explain things. That's how I learn. And we learn by, a lot of us are visual learners, so we do go to that whiteboard. But what we do is we have people in the office, and the way you get here is by calling 314-442-6476. Just schedule a complimentary consultation with us or go to our website at rickenfinancial.com.
Real simple.
Absolutely.
I need an adult, okay? These are big issues. We're talking big amounts of money. Gerry and Heidi have been at this a long time. Again, 314-442-6476, rickenfinancial.com. They're located in St. Louis there. Get in touch with them, and they'd love to help you protect and preserve the retirement you deserve, all right? Well, that's a wrap on all of that, and we're not even halfway through this mini-series on tax diversification here. We're going to get you right through the heart of tax season. But before we have any more episodes, we need to remember, Gerry, that every day
Is a holiday.
and Heidi, life is short.
Laugh hard.
Amen to that. He's Gerry Ricken. She's Heidi Ricken-Provost, and they are retirement planners at Ricken Financial. I'm Doug Turnbull. Thank you so much to listening to Kicking with the Rickens, Redefining Retirement. And thanks to our producer, Brandon Benefield, for getting this all put together. We'll have more on tax diversification coming your way here very soon. Take care.
Insurance products are offered through the insurance business Ricken Financial LLC. Ricken Financial LLC is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Ricken Financial LLC are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Ricken Financial LLC is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Ricken Financial LLC.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Tax preparation and tax advisory services services are offered through Ricken Financial. These services are not offered by IPW and are not subject to investment advisor requirements. These services referenced are an outside business activity not offered through or supervised by IPW.